Part 2. Tools of the crystal ball. Professionals use many tools to predict share prices. These include technical and core analysis. Technical. Analysts try to predict patterns by charting old share prices. These analysts are building castles in the air. It's because they think that prices depend on crowd mindset. They also believe that prices are repetitive and hence predictable. But, in reality, share prices are as random as possible. Flip a coin 100 times and draw the results. Your graphs will look similar to the share prices chart. It's because coin flips are also random. But, on charting them, you'll have long strings of tails and heads. This string looks like up and down market shifts. Worthless investing theories. Be very careful of these familiar but useless investing theories. Filters any share which shifts up from a low or vice versa is on a trend that will continue. Filter strategies. Don't do better than the buy and hold when considering transaction costs. Brokers swear by them, though, as they produce commissions. 1. Dow theory: buy when market beats its last high, and sell when it falls below its previous low. Evidence suggests it's a money-losing trick. 2. Relative strength: buy stocks which beat the market, and sell the ones who underperform. This technique isn't any better than buy and hold after transaction costs. 3. Price volume: gathers investor emotions from price rise or price falls. Trading becomes necessary because of price volume methods. Investors will earn more if they buy and hold. The returns aren't worth the transaction costs. 4. Chart patterns: computer tests show that chart patterns don't have any predictive power. These patterns include diamonds, head and shoulders, etc. 5. Hemline indicator: if hemline increases, so will the share prices and vice versa. Stock prices and hemlines have some link, but there isn't much predictive power. 6. Super Bowl indicator: NFL win leads a bull run, or AFL brings in the bears. Though this has happened, but it was a coincidence. There's no justification for seeing it. 7. As a predictor. Odd lot theory: laymen can't afford whole 100 share round lots. Hence, they buy odd lots. As they are often wrong, buy when they sell, and sell when they buy. There's no proof this works. Besides, trading costs make it costly. 8. Dogs of the Dow: buy Dow shares having the highest dividend returns. Even the person who created this trick admits it doesn't work. 9. January effect: buy at the end of the year. At that time, prices of small stocks fall, and sell when the year starts because prices rise that time. But trading expenses cancel this out. 10. Weekend effect says that shares have negative yields Friday to Monday. Hence, don't buy on Friday. Instead, buy on Monday noon. 11. Momentum investing: momentum investors drive trends. They hope that trend is their friend. It's because they think the market will keep on doing what it just did. But, in reality, momentum investors perform worse than buy and hold investors. 12. Fundamental analysis. So technical analysis is of no use. Is fundamental analysis any good? This analysis belongs to firm foundation school. These analysts believe in examining data about a firm. Such data gives a fair prediction about its future earnings. Hence, The analysts think of it as a reasonable estimate of the underlying value. But it's not possible to predict a firm's future confidently. A firm's previous earnings don't give sound estimates of its future earnings. Past performance can't work as a guide for future performance. Plus, a historical review of earnings is upsetting. Short-term estimates of analysts were even less sound than long-term estimates. Reason: there are many experts aren't that expert, they aren't perfect. But their self-confidence even beats their imperfection. 1. Stuff happens. Estimates can't forecast accidents, deregulation, terrorism, or changes in raw material prices. 2. Creative accounting: the data they're seeing could be fraudulent. 3. Incompetence: analysts are many times lazy, careless, and unskilled. 4. Corruption or conflict of interest: analysts aren't calm truth seekers. Companies pay them just because they can sell securities. The ones who can't play along can't last. 5. Index and diversify for efficiency. Overall, fundamental analysis is also useless. So, where does the investor stand now? Remember one thing: the market is more or less efficient. Hence, share prices show much crucial information about a firm's future. They also reflect the possible direction of the market. Markets respond fast to new information. This is an important factor that drives share price moves. Even Warren Buffett and Benjamin Graham said that individual investors should buy index funds. They must avoid picking stocks or investing with a fund manager. The market isn't entirely efficient. Hence, people fall prey to manias. Data may not reach stock prices as fast as the efficient market advocates think. But, overall, one can't beat the market. It's almost impossible. Still, few investors become rich by selling and buying shares. So, what do they do which others don't? Its answer is, they take the risk. The only way one may have high yields is by taking risks. A study by Ibbotson Associates showed that returns are linked with risk. Common shares belong to the maximum return asset group. They also carry the highest risk. As per modern portfolio theory, you can spread your funds over a range of risky securities, and the overall risk of your portfolio will be less than that of any security. Plus, you'll still get high returns. Diversification is the key here. It gives the lowest risk with a high return. Diversification. Place your apples in as many baskets as you can. A globally diverse portfolio has less risk than an entirely U.S. portfolio. From 1970 to 2002, the lowest risk and highest return were of a portfolio with 76% U.S. and 24% non-US stocks. But, the advantages of global diversification are reducing now. It's because developed global and U.S. markets are moving more in tandem. But, growing market changes and currency distinctions can disturb market situations. Hence, diversify across asset groups as well. Besides common shares, two other asset groups are government bonds and rights. Through real estate investment trusts, you can buy shares in real estate. These don't move in line with the stock market. Inflation is a blessing for bond investors. Hence, go for inflation-safe bonds. But, tax law is not good for them. So, use such bonds in tax-protected plans. The best an investor can do to succeed in the stock market is diversifying. Investors must also lower their costs. Also, try not to outguess others about future prices. This is because even experts fail in this. Be a passive investor who has a diverse index. This way you're likely to perform better than a person investing in actively managed funds. A random walk down Wall Street. Quotes. It is not hard, really, to make money in the market. The indexing strategy is the one I most highly recommend. A biblical proverb states that in the multitude of counselors, there is safety. The same can be said of investment. Of course, earnings and dividends influence market prices. And so does the temper of the crowd. Although stock prices do plummet, as they did so disastrously during October 1987 and again during the early 2000s, the overall return during the entire 20th century was about 9% per year, including both dividends and capital gains. As long as there are stock markets, there will be mistakes made by the collective judgment of investors. Nevertheless, one has to be impressed with the substantial volume of evidence suggesting that stock prices display a remarkable degree of efficiency. It should be obvious by now that any truly repetitive and exploitable pattern that can be discovered in the stock market and can be arbitraged away will self-destruct. The cycles in the stock charts are no more true cycles than the runs of luck or misfortune of the ordinary gambler. The mystical perfect risk measure is still beyond our grasp. Can you continue to expect a free lunch from international diversification? Many analysts think not. They feel that the globalization of the world economies has blunted the benefits of international diversification. It is clear that if there are exceptional financial managers, they are very rare, and there is no way of telling in advance who they will be.